Something is quietly waiting to take a significant amount of money from thousands of retirees this year, and most of them will not see it coming until it is already too late. It does not come from a bad investment or a financial mistake you made recently. It comes the moment you sell the home you spent your entire working life paying for. And the most painful truth is that the money never had to leave your hands at all, if you had known this one rule before that day arrived. Before we go any further, I want you to think of this channel as your personal lookout for retirement finances. Every week here, we cover the real rules, the hidden conditions, and the fine print details that quietly cost retirees money they spent decades protecting. If you want to stay a step ahead of what the IRS already knows and that most people never stop to explain directly to you, subscribing right now is one of the simplest and most valuable things you can do for your retirement security. It costs nothing. It takes 1 second, and it means the next time a rule like this one comes up, you will already know it before it matters most. Let me be direct with you from the start. Everything in this video is designed to give you real understanding, not fear and not confusion. You do not need to have a background in accounting or tax law to follow along here. You just need to know what questions to ask and what steps to take before you make one of the biggest financial moves of your retirement. I have built this from beginning to end so that by the time we close, you will have a clear picture of what this rule actually says, where most retirees quietly go wrong, and what you can start doing today to protect the money you spent a lifetime earning. There is one small timing detail woven into this rule that most retirees miss completely. I'm going to come back to it in a few minutes, and when I do, it will explain why so many people end up blindsided at the worst possible moment. For now, let us start at the very beginning. When you sell your home for more than you originally paid for it, the profit from that sale is called a capital gain. The IRS considers that profit to be income, and income can be taxed. This surprises many retirees deeply because after 30 years of paying down a mortgage and watching the neighborhood change around them, they feel as though that house is simply theirs, finished and untouchable. But in the eyes of the tax code, a profitable sale is still a taxable event, whether you expected that or not. Now here is where the law genuinely works in your favor, provided you know about it. The IRS has a rule that allows most homeowners to exclude a very large portion of their home sale profit from taxes entirely. If you are a single filer, you may be able to keep up to $250,000 of that profit completely free from federal capital gains tax. If you are married and file jointly, that protection doubles to $500,000. For many retirees who bought their homes decades ago at prices far below today's market values, this exclusion can cover the full gain entirely, meaning zero federal tax owed on the sale. But this protection is not automatic, and it is not guaranteed. It comes with real conditions attached to it, and meeting every single one of them is what separates a clean sale from a costly and unexpected bill. The first condition is that the property must have been your primary residence, which sounds simple, but carries much more weight than most people realize. The IRS is not simply looking at whose name appears on the deed. It is looking at where you actually lived. The IRS considers things like where your mail was delivered, which address your driver's license carries, where you are registered to vote, and where you genuinely spent the majority of your time throughout the year. If you owned the home but rented it out while living elsewhere, or used it primarily as a seasonal property while your main life was centered in another state, the IRS may not recognize it as your primary residence regardless of how long you held the title. Here is a question I want you to sit with right now. Do you know exactly how many months ago you last lived in your home as your full-time primary residence? Because that number, sitting quietly in the past, may already be affecting your tax situation in ways you cannot see from the outside. Keep going because what comes next shows you precisely why that answer is so critical. The second major condition is a timing requirement that catches many retirees completely off guard. The IRS requires that you must have owned the home and lived in it as your primary residence for at least 2 years out of the 5 years immediately before the date of sale. Those 2 years do not need to be consecutive. They just need to total at least 24 months within that 5-year look-back window. This is what directly connects the timing of your move and the timing of your sale in a way most people never anticipate before it is too late to change anything. Think about how naturally this plays out in retirement. Your health changes. You move closer to family. You settle into a smaller, more manageable space. Your old house sits there while you figure out next steps. A year goes by, then two, and eventually you decide to sell. But by then, 3 or 4 years may have already passed since you last lived there as your primary home. Even if you owned the property for 30 years and paid it off completely, the exclusion is tied to recent residency, not total ownership time. When that residency window closes, the full protection closes with it. Now let me plant something in your mind that I want to come back to very shortly. There is a detail about your home's documented history that most retirees have never considered, and it has the power to reduce your taxable gain by tens of thousands of dollars on its own. Keep that thought close, because I will land on it in just a few moments. But first, let me show you exactly what is at stake using a real example with real numbers. Imagine a married couple who bought their home in 2002 for $160,000. They raised their family there, paid it off completely, then retired and moved into a smaller place but kept the old property for a few years. When they finally sell 4 years after moving out, the home brings in $720,000. That appears to be a gain of $560,000. If they had sold while still inside the residency window, they could have potentially excluded $500,000 as a married couple, leaving only $60,000 taxable. But because they waited too long after moving out, they no longer qualify for the exclusion at all. Now the full $560,000 may be treated as taxable gain. That single timing decision, how long to wait after moving out before selling, can translate into an enormous and completely avoidable tax burden. Now let us get to that cost basis detail I teased a moment ago, because this is one of the most practical pieces of information in this entire video. The IRS does not calculate your gains simply by subtracting your original purchase price from your sale price. It uses something called your cost basis, which starts with what you paid to purchase the home, but can grow over time based on major improvements you made to the property. When your basis is higher, your calculated gain is lower, which means less of your profit is subject to tax. Every major improvement that added real value to your home can potentially be added to your cost basis, as long as you have the right documentation to support it. Improvements that count include things like building an addition, completing a full kitchen or bathroom renovation, replacing a structurally failing roof with a new permanent installation, upgrading the electrical system, adding a garage, finishing a basement into usable living space, or installing a new HVAC system. These are changes that increase the value of the property, extend its useful life, or adapt it to a new purpose. They are entirely different from ordinary maintenance. Repainting walls, fixing a dripping faucet, replacing a broken appliance, or patching a small section of flooring are routine repairs that keep the home functioning, but do not count toward raising your cost basis. That distinction is not just technical knowledge, it is money that either gets credited to you or disappears forever. And here is that documentation detail I told you to hold in mind. The single biggest reason retirees lose this cost basis advantage is not that the rule does not apply to their home, it is that they simply do not have the paperwork anymore. The IRS cannot credit you for improvements you cannot prove. Contractor invoices, project receipts, county permit records, bank statements showing large renovation payments, even approved written estimates. All of these become financial documents when the time comes to sell. Many retirees made significant upgrades throughout the 1990s and 2000s and never imagined that a receipt from a contractor would carry real tax value 2 decades later. Without that documentation, the taxable gain appears larger than it actually should be. Let me show you what this means with hard numbers. Imagine a single homeowner who bought her home in 1994 for $115,000. Over the years, she added a sunroom for $28,000, replaced the full roofing system for $16,000, and remodeled a bathroom for $19,000. Her documented cost basis rises to $178,000. She sells today for $560,000, creating a calculated gain of $382,000. As a single filer, her exclusion is $250,000, leaving $132,000 potentially taxable. Without those improvement records, her gain would appear as $445,000, making the taxable portion $195,000. That is $63,000 more in taxable income, created by nothing other than missing paperwork. Let me stop and ask you something important right now. When is the last time anyone sat down with you and specifically walked through your home's cost basis, including every major improvement you have made over the years? If the honest answer is never, or if you are not confident your records would hold up, this is worth addressing now, well before the year you plan to sell. Keep going, because there are several more pieces ahead that matter just as much. Let me address a belief about home sales that circulates in retirement conversations so frequently it starts to feel like settled truth. Many people believe that if no tax is owed on a home sale, because the exclusion covers everything, the sale does not need to be reported to the IRS at all. The truth is that the IRS typically receives information about home sales through independent reporting channels, and if your tax return does not reflect the transaction, it can create a mismatch that triggers letters and notices. Reporting the sale correctly, even in a year where the full gain is excluded, is what creates a clean and protected record. It takes far less effort than managing the questions that arrive when the sale is simply left off the return. There is also a rule about how often you can use this exclusion that most people have never even heard of, and I want you to hold on to it because it applies more often than you would expect. Generally speaking, you cannot claim the primary residence exclusion more than once in any 2-year period. For most retirees who sell one home and settle somewhere permanent, this limit never becomes an issue. But for those who downsize more than once, or sell and then buy and sell again within a short time frame, this restriction can cause the second sale to become fully taxable even when all other conditions are perfectly met. If you are planning more than one home transaction in the coming few years, this timing rule belongs in your conversation with a tax professional. There is one more situation that deserves its own moment because it carries a time-sensitive urgency that most families never hear about at the right time. When a spouse passes away, the surviving spouse may still qualify for the full $500,000 exclusion on the home if it is sold within a specific window after the loss and all other residency and ownership conditions are satisfied. If that window passes before the home is sold, the exclusion available may drop to the single filer amount of $250,000. That difference is often significant, and this is exactly the kind of rule that tends to surface only after the window has already closed. Knowing it in advance is what makes it possible to act while the option still exists. Here is something I genuinely want you to consider right now. Is there someone in your life who recently lost a spouse and still owns their home, who might not know that a time-sensitive window could be running at this very moment? Passing this along to them could be one of the most quietly impactful things you do today. Now let us move into the most common mistakes, because this is where knowing what not to do becomes just as valuable as knowing the rules themselves. Let me walk you through 5 mistakes that show up repeatedly among retirees dealing with this rule. These are not careless errors. They come entirely from not having the full picture in advance. The first mistake is not noting the exact date of moving out of the primary home. Once you stop living there as your main residence, the 5-year window begins. Many retirees underestimate how much time has passed and discover too late that the 2-year residency requirement is no longer met by the time they are ready to sell. The second mistake is letting improvement records disappear over the years. Receipts and contractor documents from 15 or 20 years ago feel completely irrelevant until they are suddenly the difference between a manageable tax bill and a shocking one. Collecting whatever documentation still exists, even imperfectly, is always better than having nothing at all. The third mistake is expecting the exclusion to cover a vacation property or rental simply because it has been owned and loved for years. Personal history with a property does not change how the IRS classifies it. The exclusion follows primary residence, and the IRS definition of that term is very specific. The fourth mistake is calculating the home sale tax in isolation without looking at how it affects the rest of that year's income. A taxable gain can push more of your Social Security benefits into a taxable category and can trigger higher Medicare premium surcharges. The full-year income picture matters, not just the single line on the return for the sale itself. The fifth mistake is waiting until the year of the sale to look at any of this. By then, most of the options that could have reduced the tax impact have already closed. Starting to review the full picture 1 to 2 years before selling gives you real room to make decisions that actually matter. Now, let me speak to 3 different situations, because the people watching this are coming from very different starting points right now. If this is you, you moved out of your home within the past year and you are still holding on to it while you decide your next steps. You are likely still inside the qualifying window, but the clock is already running. Figuring out exactly how many months you have remaining before the residency requirement expires is the most time-sensitive item on your financial to-do list, and it directly determines whether selling sooner or later costs you more in taxes. If this is you, you are still living in your home, you have been there for years, and you plan to sell eventually but have not yet started thinking about the tax picture, you are actually in the strongest possible position right now because you still have time. Start gathering improvement documentation today, before the sale is anywhere near the horizon. That preparation, done calmly and without pressure, is what turns a potentially stressful process into a straightforward one. If this is you, you own a vacation property or second home and you have quietly assumed the same exclusion applies there as it does for your main residence. This is the moment to revisit that assumption. The rules are genuinely different, but with sufficient lead time, there may still be meaningful options available to you. The earlier you have that conversation with a qualified tax professional, the more those options remain open rather than closed. Here is what you can do starting today, laid out as concrete actions. First, write down the date you moved into your current or most recent primary home, and if you have already moved out, write down that date too. Then count the months between your move-out date and your anticipated sale date so you know exactly where you stand inside the 5-year window. Second, start an improvement folder right now, either a physical envelope or a digital file, and fill it with every receipt, contract, bank statement, or permit record that relates to major work done on the home. Third, if you remember making improvements but cannot find documentation, write down the details anyway with your best estimate of dates and costs, because even that record supports a productive conversation with a tax professional. Fourth, schedule a meeting with a qualified tax professional at least 1 to 2 years before you intend to sell, and specifically ask about your cost basis, your residency timeline, and which calendar year positions you best from an income standpoint. Fifth, if you own any additional properties, treat those as a completely separate conversation, because they follow a different set of rules and may need their own distinct plan. One more thing before we wrap up. If you ever receive a phone call, a text message, or a letter from someone claiming to represent the IRS and telling you that you owe money immediately related to a home sale or any tax matter, slow down before you do anything at all. The IRS does not make unexpected calls demanding immediate payment. They do not send text messages with links asking you to click for urgent information. They do not threaten arrest or immediate legal action during a phone call. If any contact feels rushed or pressured, end the interaction. Do not hand over any personal information, and verify the situation by finding the official government contact number yourself through a trusted search. Never share your social security number, bank account details, or any financial information with someone who reached out to you first. Let us bring everything together now. When you sell your home for a profit, that gain is potentially subject to capital gains tax. The IRS allows a meaningful exclusion: $250,000 for single filers and $500,000 for married couples filing jointly. But only if specific conditions around primary residence and recent residency are met. Your taxable gain can be reduced by raising your cost basis through documented home improvements, and there is a clear line between improvements and ordinary maintenance that determines what counts. The exclusion does not automatically apply to vacation homes or investment properties. Selling in a lower income year can reduce the rate applied to any taxable gain, and a taxable gain can ripple into your Social Security taxes and Medicare premiums for that same year. You must report the sale correctly on your tax return even when no tax is owed. And the exclusion generally cannot be used more than once in a 2-year period. Here is the final thought I want to leave with you. The tax rules around a home sale are not designed to punish people who worked hard and built real equity over a lifetime, but they do reward the people who understood the conditions and prepared ahead of time. And they quietly cost the people who assumed that years of ownership and a paid-off mortgage were enough to protect them on their own. Your home may be the single largest financial asset you have built across your entire working life. Treating its sale as purely a real estate decision, without a serious look at the tax picture first, is the one move that nothing else in your financial plan can fully correct after the fact. But here is what I want you to carry out of this video. You now have the full picture. You know the conditions, the documentation to gather, the timing to protect, and the conversations to start before the sale date is on top of you. That knowledge puts you ahead of most retirees who never learn any of this until it is already too late to act on it. So tell me this, as you leave today. After everything you just heard, what is the one action you're going to take this week to make sure your home sale puts more money in your hands and less in the IRS's?